My name is Jake, welcome to the channel. In today's video, we're gonna do a review my pie video where I review subscriber portfolios. I've been doing this for a handful of years. I really enjoy it. It's very different than the other videos on my channel, and I see it more as just a casual conversation. If you and I were sitting down together, we're having a conversation, these are generally the things that I would share with you. I am so excited to share that today's video is presented by Snowball Analytics. Snowball Analytics is a tool that I use to track my dividend income and analyze my portfolio. I personally use Snowball Analytics and give it my stamp of approval. Whether you're a new or existing Snowball Analytics user, use promo code DGI to get the very best pricing. And I try to do this Review My Pie series once a month, so I try to mix it up a little bit. I talk about different topics. I talk about, different ETFs, different strategies when it comes to dividend investing. Obviously, the FIRE movement and financial independence, retire early. I mean, that's really been top of mind for me these last couple of years. You'll notice here on your screen, it looks a little bit different. So I transferred my real estate brokerage that I had in M1 into my cash flow portfolio. Before, I had two brokerages or two accounts in M1. And the reason why I did that was originally when I set up the account, I had it to separate, qualified versus non-qualified dividends. So REITs are non-qualified. And so it was kind of a helpful way for me to kind of see, okay, how much of my income is going to be qualified versus non-qualified. But now, because I have, cover call ETFs in here like JEPQ and JEPI, the dividends are already, they're kind of mixed. They're not all qualified. And so I thought to myself, you know what? Let's just combine them into one brokerage. So it was really a cool experience because I've never had $1 million in my life in one place. And so seeing the 7 digits, well, I guess 9 digits if you add the decimals, but the 7 digits here is absolutely incredible. I look at that and I think to myself, how did a kid from northern Utah that worked at a donut shop making $5.15 an hour ever accomplish something like this? I wasn't fed with a silver spoon. This was blood, sweat, and tears for many, many years, many sacrifices. You're not seeing that on this screen. You only see what I'm displaying. You don't see the hours and hours of struggles and frustration and the uphill battles that went into this. If you're looking at this, I hope you see this as a form of motivation. I try to be grounded and try to share what it's really like, and that's why I created this YouTube channel. So I'll probably talk more about this portfolio maybe in another video. These Review My Pies, they're not about my portfolio, it's about your portfolio. And so I want to focus on, the portfolios that you all have submitted to me. But yeah, let's take a look at it. So we're going to take a look at one question from a 54-year-old here in the US, and then we're going to take a look at 3 portfolios. The first is for an 18-year-old here in the US, the second, a 23-year-old from Europe, and then the third, a 49-year-old from the US. And as always, everybody, the timestamps will be in the description below, as well as the portfolio links will be in the description below. And as always, this is not financial advice. This is just merely for your entertainment. So please don't take what I'm saying as financial advice. I talk a lot about different strategies and different, things that, I've learned about through trial and error and things that have helped me on my quest to reaching financial independence. But I just want to say, if you want to retire off of your dividend portfolio like I did, and you are investing only into individual stocks, I hope that you stumble across my videos where I talk about the simple path to wealth with dividend investing using the core and satellite approach, where you're investing in a core portfolio of SAHD and DGRO, and you have, satellite positions to boost either your yield or your growth depending on your particular situation. And it's my personal opinion, if you're doing that and you're following this strategy and your goal is to live off your dividend portfolio, you are winning at life. And it could look a little like this. Oh man, doesn't that feel amazing? Like if you've been investing into individual stocks and you found the light and you are now following the simple path to wealth with dividend investing, which was inspired by J.L. Collins that I talk about on my channel. If you're doing this, if you go from only investing into individual stocks, losing sleep at night, to finding this, I'm sure that those chills that go down your back, they're real. So yeah, at least it was for me. But anyways, let's take a look at this first question here. There's a lot of text in this email, and it's from Sean. He's a 54-year-old. He tries to understand, the why around investing, like why he wants to understand why certain things are the way they are. And I want to just focus in on the main piece of his question. I'm not going to read the entire email. So his question is, why did I choose a brokerage account over a Roth or even an HSA account for my portfolio for my dividends? Now, this is a really great question, and it was a question that I was faced with many years ago. Because traditional wisdom was that you max out your 401k, you max out your Roth IRA, and you call it a day. Now, for most people, that is a great idea. It's a great option. But I realized that my goals were different, right? When I first started, I was trying to, invest and figure this whole thing out. I was in my late 20s, and I realized that I didn't want to wait until I was 59 and a half to be able to live off of my portfolio. And so that right out of the gate, I was thinking to myself, well, I'm doing this wrong. If everybody tells me to invest everything into 401k and a Roth IRA, but I'm different, or I have different ambitions, different goals. And that I really struggled with that because it went against conventional wisdom. Okay, because this whole follow the herd mentality is real. And when you go outside of what is generally accepted as normal, you kind of start to second guess yourself. Is this right or is this wrong? So if you're in a different situation, maybe you're in your 20s, 30s, or 40s, or even in your 50s, your early 50s, and you want to retire before the traditional age of 59 or, beyond so that you can access these retirement accounts, penalty free, you have to think of it a little bit differently. So to answer your question, Sean, the reason why I invested with dividends in a taxable account is because I want to access the income before. Now, if I was later, if I was older and was going to be retiring and living off my portfolio, after the age of 59 and a half, absolutely, I would be maxing out my 401k, my Roth IRA, etc. Okay, absolutely. But because my time horizon is different, that is why. Because, when you're new to investing, the first thing that you kind of learn about the different investment accounts. You learn about growth versus dividends. And you always hear as conventional wisdom, which is good wisdom, that you should put your dividend stocks, your bonds, dividend ETFs in a tax sheltered account because you're getting taxed on the dividend, the income. And that is absolutely correct. That is true. The thing that you have to understand though is, well, what is your goal? If your goal is to access the income after the age of 59 and a half, that checks all the boxes. That is completely correct. But what happens if you want to access the account before the age of 59 and a half? You have to think differently. And so it goes against conventional wisdom and what you'll normally see online as, practical advice. But you have to understand the advice that people are giving, generally it's tailored to the masses. Okay. And so you have to look at your own particular situation, where you're at, and then make the best decision for you in your particular situation. But to answer your question, I do also invest in a Roth IRA. I do also have an HSA. In my taxable accounts, I invest for dividend growth, where I can live off the income today. But in my retirement accounts, I have an entirely different strategy, and I've shared videos on this. Just go on my channel and check out my Roth IRA videos. But I invest entirely for growth in my tax advantaged accounts because I'm going to rebalance in the future because I don't know what the future is going to hold for me. Maybe when I'm 60, I want to buy a house. I want to, whatever. Maybe I, sell everything in growth and then buy all SAHD and DGRO, or JEPQ. I don't know. So it's just really, really important that you understand that you understand your particular situation. But somebody who's 54, and if you know that you're going to retire after the age of 59 and a half, it's a no-brainer. Go all in on your retirement accounts. Now, if you're in your early 20s or if you want to retire before that, you might want to think outside of the box and you may have a different approach, and that's okay. So yeah, Sean, thank you so much for the question. This is a really, really important question that everybody has to understand. It's not just about, what you invest in terms of the, the vehicles, the stocks, the ETFs, but where you invest, right? In which account type. So yeah, Sean, thank you so much for sending over the question. All right, let's take a look at the first portfolio here from Chris. He writes, Jake, love your enthusiasm, and I've learned a lot from watching your videos. Enthusiasm? I have enthusiasm? Thanks, man. I appreciate it. He's probably referring to and it looks a little like this. All right, cool. So today I helped my 18-year-old daughter create a new M1 Finance Roth IRA. I considered just copying your shared FIRE M1 Pi. However, as she is a freshman college student and wanted to set up, she didn't need to watch or manage at this time. Thus, zero stocks, at least in the beginning. At the beginning, I didn't want to set her up like my own or my wife's account, so I chose these 5 different ETFs. Yeah, absolutely. You do not want to invest her in her Roth IRA like my, taxable brokerage account, because it boils down to, time horizon and understanding growth rates. Okay. So very, very important. Obviously, so she's in a different time horizon than you and your wife. So it's very, very important that you understand that. Some of these choices stem from my discussions about investing, but mostly from her conversation with friends and family. Lots of suggestions, perceived pressure about the need to buy stocks in different sectors. So we helped find insurance, REIT, utility ETFs that contain some of those mentioned companies. I'm hoping she can show her friends in 6 months or a year that these choices are growing. What are your thoughts? Okay, so Chris, well, first off, I think it's just great that you're starting off helping your daughter at the age of 18 to invest into her future. So kudos to you. I think it's absolutely important. And I think the world has changed, right? Like when I was 18 years old, I was concerned about leveling up my warrior and WoW and playing video games, going and doing random things. Like I wasn't invested into investing. I wasn't interested in investing. And I think that's changed for the younger generation here, because they see all the turmoil and everything that's going on with the market and how it's impacting their parents and society as a whole. But you're off to a great start. You understand that it's important. What kind of concerns me about reading this is the social pressure with her friends, because that's going to be a big issue, I think, going forward. You don't need social confirmation from your daughter's 18-year-old friends whether or not the choices are correct or not. Okay, asking an 18-year-old daughter or boy or whoever, kid, young adult, what the future is going to hold and how to invest, that is a bad idea. So I would cancel out that noise entirely. And it's like, you know what it's like? It's like you're sitting in a classroom, you're having a test, and you're looking at your neighbors, trying to cheat off your neighbor, but your neighbor is stupider than you are and doesn't know what they're doing. And so you might be copying or getting advice from a source that's probably not going to help you in the end and doesn't have your best interest in mind in the end. That's the very first thing that I would say is avoid the noise. Make sure that you teach and help your daughter understand that there's going to be a lot of noise and that investing is emotional, and she has to understand why she's investing, the importance of it, and what is her goal behind it. Okay. And so that's probably, if you take anything away from anything that I say, that's probably the most important thing, is help your daughter to understand that her friends should be her friends, not her financial advisor. Okay. That's the first thing. The next thing that you want to make sure that you help your daughter understand are fees. And something that comes to mind is, have you ever heard of J.L. Collins and The Simple Path to Wealth? I can highly recommend you consider reading the book yourself and sharing it with your daughter, because J.L. Collins actually wrote The Simple Path to Wealth and created his blog and all this content on behalf of his daughter. Okay. And so it might actually be beneficial for you to read it and then to pass that wisdom on to your daughter. Now, the Simple Path to Wealth with J.L. Collins is more focused on the 4% rule, traditional, investing in the total U.S. stock market, and then liquidating your shares in retirement is pretty different than what I talk about. I took inspiration from J.L. Collins and focus on keeping your dividend portfolio simple. So that may be something that you may want to consider, but let's take a look at your portfolio. But just remember, understand investment time horizons, because your time horizon is going to be very different than your daughter's. All right, let's take a look at the portfolio here. This is actually a new dashboard or a new view from M1. So if you've watched my other Review My Pies, this looks a little bit different, but let's take a look and see what you have. You have SHD, you have a utilities ETF, an insurance ETF, a ProShares High Income ETF, and you have a REIT ETF. And so this is in a Roth IRA. I don't like this. I don't like this at all. I guess, the only thing that I like is SHD in here. What I would recommend you do is, like I said, understand growth rates, understand how your investments are going to grow. Like a bond is expected to grow at a certain percentage annually over an extended period of time. The US stock market is expected to grow at a certain percentage year over year. Obviously, past performance never guarantees future performance, but I would skew this portfolio heavily into broad-based low-fee index funds. I would get rid of this, if it was me, I would get rid of this high-income ETF. Why? You don't need this. You could have the REIT ETF, 15% is fine if you absolutely want exposure to it. Insurance, I would get rid of this. Utilities, I would get rid of this. Why not consider, a growth ETF like SPYG or VUG that incorporates growth utilities, growth insurance companies, right? That are growing faster. Like this is what you want to invest in if you're nearing retirement. Okay. And I'm sure her friends say, hey, Warren Buffett invests into insurance. Our car premiums have tripled in the last 2 years. Therefore, insurance is a great buy. You should go invest into insurance. I'm sure that's exactly what happened. Or you live in Florida and you saw your condo insurance triple, right? So that's where this recency bias kind of comes in. Now, insurance is a great place to invest, but I get exposure to insurance through other market ETFs, but they're not screened explicitly for insurance. To be very honest, how I would look at this, I would try to simplify this even more. You have a good amount focused on dividends. And when you're 18 years old, you shouldn't be thinking about dividends. So 59 minus 18, you got 41 years to grow, to compound. Why do you want to skew your portfolio so heavy in high dividend stocks that are growing slower? I would much rather, in my opinion, I would much prefer to stomach the volatility, invest into, the total US stock market, growth ETFs, and skew the portfolio that way. And so that's how I would look at this. For example, me, I'm 38 years old. In my Roth IRA, I don't invest for dividends. I invest for growth, right? And I never said I was good at math. So 59 minus 38, I have over 20 years to just let my portfolio, grow on cruise control in the background. So if I'm investing purely in growth with a 20-year time horizon, I think your daughter should really consider investing more into growth with a 40-year time horizon. But make sure that you're focusing on fees, low fee index funds, broad-based. I don't necessarily like the insurance utility play here. I definitely don't like the high income for this time horizon. REITs, you could probably even lower the REITs to maybe 5 or 10%. I personally would probably lower SCHD, and I would throw in a 1 or 2 growth ETFs, and I personally would throw in something like VTI, the total US stock market, and call it a day. And I would ignore teach your daughter to ignore the noise, especially her friends, because that's going to be the biggest issue that your daughter's going to face, more so than picking the right sector to invest in. And then the last thing here, Chris, something that you'll want to do and help your daughter understand is understanding the rule of 72, how growth rates work and how that impacts compounding over an extended period of time. But yeah, thank you so much for sending over the portfolio. The next portfolio is from Tiago. He writes, "Hi Jake, I know you talk for Americans, but I like your videos and I'd like for you to give me some advice." Well, I don't just talk to Americans. I just know the ETFs better here in the US. Like if you were to ask me, what are some of the best European or Canadian or Australian ETFs, I just don't have those on my radar. So I can't really help you with those, but all my other content in terms of time horizon, keeping things simple, strategy and stuff like that absolutely applies regardless of where you're at. He continues writing here, "I'm 23 and I'm from Europe. I work as a waiter in a bar and I only work 8 months out of the year and go unemployed for 4 months. I just started investing like 2 months ago. I have roughly 2K invested and I invested into the S&P 500 because I'm new and I would continue to invest monthly in it and sell when I retire. I have some other stocks that I bought but I don't still understand very much about dividend investing." Okay. Yeah. So you're investing in the S&P 500 and yeah, that's a great place to start. "My target is to build long-term wealth along with building a reliable dividend income for the future. I saw your videos about dividend investing and the dividend snowball, and I started a pie and wanted to know your opinion. I would do a start amount of $1,000, but would add an additional $200 and reinvesting all dividends until I could have a lot of shares that can give me a source of reliable income. I went for a mix of yield and some growth stocks." He sent me a link here with a track your dividends. We'll take a look at that. So I'm not going to look at that right now. "You think I should, instead of the 10 stocks, should lower it so that you can have 5% in each." Okay. "I do my trading in Trading 212 because I still don't understand very much about 401ks and Roth IRAs in Europe. Sorry for my English. It's not my main language." Hey, dude, your English is better than I'm sure where I can't speak your language. So this is great. So you'll have to do some research on your country's 401k or equivalent options like, your tax advantage accounts. What I always recommend you do is Google it in your native language and try to research it that way. Don't Google it in English because you're going to get stuff from Britain or from all over the place. So make sure that you are Googling this in your native language. And, but yeah, so when it comes to the 5% per individual stock, absolutely, I would not have more than 5% in a single stock. It's just for me, why risk it? Especially if you have ETFs that have, overlap, in my opinion, it just isn't worth it. So that's what he's referring to here with the 5%. All right, so let's take a look at your portfolio. I can see here that you got a handful of companies in here. So you got AbbVie, Chevron, Johnson & Johnson, Coca-Cola, Legal, I'm not familiar with this one, Lowe's, Maine, Realty Income, Altria Group, Microsoft, Realty Income, Rio Tinto, Target, T. Rowe, Visa, Vici, and Waste Management. Okay, so you have some really good companies in here. What about ETFs, right? Like if you're only investing into individual stocks, it makes this whole process a lot more manual, and you have to follow up on these companies. You have to follow up on your portfolio. Have you considered, ETFs, right? And so the core and satellite approach, it really is my preferred way to invest because it's just easier. It's simpler, right? And so if you don't have any ETFs, you have to manage your risk a lot better. You have to kind of look at, different sectors. You have to keep that on your mind. Do you have too much in healthcare, too much in technology, too much in consumer, discretionary, whatever. With ETFs, it doesn't matter, right? Because you're getting exposure to every sector, and in many cases, they're market cap weighted. In terms of the stocks, I think, you're still very, very young. I would probably recommend skewing this a little bit more towards growth, right? I do like that you have Lowe's. You do have the T. Rowe's, Vici's, Visa, Waste Management. In my opinion, I would probably try to aim for a portfolio average or weighted average dividend yield of around 2.5% to 3%. And I would try to focus on a portfolio weighted average dividend growth rate of around 9 to 12% on average. Like that would be my recommended target. Like you should try to be focusing on, companies that are going to have a starting yield between 2.5% and 3% and are growing their dividend year over year between 9 and 12%. Now, that's a little bit more manual when you're investing into individual stocks, right? It's kind of like a balancing act. Now, if you invest into SHD and DGRO, for example, you don't have to do that. Like all the heavy lifting is done for you for the most part, right? And so that's why it's easier with the core and satellite. Yeah, if you're doing this manually, it's going to be a little bit more work and you're going to have to follow up on it a little bit more. But the biggest advice that I can give you and anyone watching in terms of constructing a portfolio is don't look at the individual positions alone. Look at how the individual positions contribute to the portfolio weighted average. Okay, I'm going to say that one more time because it is so important. I wish that I understood this when I first started investing. Don't look at one single stock and that's the end of it. Look at how that single stock contributes to your overall portfolio goal. And your portfolio goal is your weighted average based off of the weighting of each individual holding. What is the weighted average dividend yield? And what is the weighted average dividend growth rate of your portfolio? And that is what you should be focusing on. And if you do that, you're going to level up your game and you're going to be on the right track because that is your North Star. That is what's guiding you and helping you to build a portfolio that will help reach your goals. Okay. But once again, if you don't know your goals, how are you going to build a portfolio that's going to meet your goals? You get that? You understand that? Light bulb? Okay, good. All right. Well, hey, thank you so much for sending over your portfolio and shout out to Europe. All right, let's take a look at the last portfolio here from Kevin. He writes, "Hi Jake, I found your channel about a year or so ago. I don't really consider myself a dividend investor as I actively manage my portfolio, but I did see we have a lot in common with our investments. I prefer to sell puts and calls running the wheel. Awesome job on your put and call videos recently. When I was 18, I'm now 49. I started working at a bank and opened up a traditional IRA. No longer at the bank and have much less stress-free career now. I've been maxing it out every year, so the bulk of my money is in my traditional IRA. I went for the traditional IRA just so I don't have to deal with the taxes. I was not a fan of M1 after I watched your first video since I couldn't place good to cancel orders, so limit orders, I guess you could say. But I decided to throw some money into a Roth IRA on M1 and try it out. I don't have much in there right now, just testing it out. That's the exact same thing that I did. When I first tried out M1, I transferred over $200 and wanted to test it out and see if it was for me. So I think that's a smart idea. M1 is great if you are interested in automating your portfolio. I think there's a lot of pros and cons depending on what you're trying to do. Just understand M1 is not a trading brokerage. It's really for passive investing. On M1, I put everything into ETFs. It seems to be doing well, but would love to hear your thoughts on it. I'm in the US and my goal is to retire in October when I turn 50, but I'll see what the wifey has to say about that. Aside from the M1 Roth IRA, my company has an ESOP. Is it ESPP? ESOP. They fund for me as well as a 401k and cash account and the bulk in the traditional IRA. Hope to hear your thoughts if there is anything you would change in the Roth IRA. Besides my ESOP and 401k, I do not actively manage the Roth. Drives me nuts sometimes. I want to sell then rebuy on the dip, but I'm letting the experiment run. Have a good one and look forward to your next videos, Kevin. Yeah, man, I'm notorious for buying the dip and then buying it again and then selling it and then buying again. Like that's how I first started investing, and it was a roller coaster and it was horrible. Once I fully really started focusing on ETFs, it really helped me sleep better at night. It just makes things so much easier, and I much prefer it, right? It helps you to, it allows you to focus on other things in life. Investing is great. It's a hobby, it's a passion, whatever you want to call it, but it's not your life, okay? And once I realized that, I embraced index investing and I have not looked back. So there's a lot to unpack here. You're 49 years old. You said that you want to retire at the age of 50. Well, you're going to have to wait with your traditional IRA unless you do the Roth IRA ladder, right? Where you're, converting it into your Roth IRA and then you kind of live off the contribution. You could do that, but you have to plan 5 years in advance. So the Roth IRA conversion ladder is what that's called. And so maybe you've heard of that, maybe you haven't. Might be something you want to check out. It looks like you have to bridge from the age of 50, pending the wifey's decision, to the age of 59 and a half when you can access your retirement accounts. So, and this kind of ties back into the first question, right? Why I invested in a taxable account is for exactly this reason. So I didn't have to wait until I was 59 and a half to access the money penalty free. But yeah, let's go ahead and let's take a look at your portfolio. All right, so in your portfolio, this is your Roth IRA. This is one that I guess you're just automating here in M1. It's kind of an experiment is what it sounds like. You got 10 holdings in here and they're equally weighted. They're all ETFs. Okay, so ETFs, can't go wrong with that, in my opinion. You got growth ETFs and you got dividend ETFs in here. Okay, so you got SPYG. I really like this. This is a great growth ETF. You got VUG, great growth ETF. You got SHG, great growth ETF. You got QQQ, great growth ETF. I would recommend looking at QQQM. You're going to get a lower expense ratio. You got VGT, also a great growth ETF. And then we get into the dividend ETFs. So you got half in growth, half in dividend or a higher dividend, kind of like a mixture, dividend and dividend growth. You got DGRO, SHD, and well, you do have VTI. So I guess 60% would be categorized as growth and 40% dividend growth, and HDV and VYM. So right off the bat, there's a couple of things that you want to understand. The first thing is this is a lot of ETFs. I don't think you have to have all of these. You know, you could consolidate, instead of having, 6 different growth ETFs, you probably could get away with 2 or 3, right? And similarly with the dividend ETFs, you probably could get away with 2 or 3. So not always more is not always better. More sometimes adds complexity, and complexity is not a good thing. Okay, especially when we're investing. Wall Street would like you to believe that complexity is a good thing or that it's over complex. The focus should be on how do we keep things simple, okay? And so that's the first thing. In terms of all of the investments in here, I really like all of them, right? So it's not me saying, hey, you should sell one of them because I think that they're a bad apple or something like that. I think every single one of these ETFs are fine. The question is, do you really need them, right? Like that's really the question. And so maybe you could consolidate, and that's just my personal opinion, okay? And so the next thing that you have to understand is these are 2 fundamentally different investment approaches, okay? The dividends versus the growth, it's an entirely different strategy. So you have to make sure that you understand why you're investing, right? So VGT and VUG and these growth ETFs are like a Ferrari, okay? And then DGRO and SEHD, they're kind of like a Hummer, right? Like they're big, don't get too, caught up in the example here, but they're a Hummer, okay? The difference is you're not going to take a Ferrari off-road in the mountains, just like you're not going to take a Hummer to really, go on the racetrack, right? They're different vehicles, different strategies, okay? And so you have to make sure that you understand your why you're holding these, okay? And it's the way that I always look at this, I've shared this many times, is I look at my ETFs, my investments, the same way that I look at real estate, right? My dividend stocks and ETFs are like rental properties. I'm a landlord, right? I'm owning the real estate, I'm owning the dividend ETF, and its purpose is to generate cash flow. I don't care if it appreciates 10%, 20%. I don't really care much about the price appreciation or what the price does. I care about the growth of the dividend and that the dividend's sustainable, okay? On the other side, with the other side of real estate, if I'm trying to buy a house low and I want to flip it for a profit, that's like investing in these growth ETFs, right? The purpose is to buy it low and into anticipation or hope that in the future, somebody's going to pay more for it and you're going to sell it for a gain, okay? And that's very, very different depending on, what you're trying to accomplish, right? Are you trying to live off the income, or are you going to sell shares in the future? So there's nothing wrong with this portfolio. You just have to understand why you're investing in it, right? So that's really the most important thing, is understanding the purpose of each of these investment vehicles and how they're going to get you to your destination. Okay, does that make sense? That's at least how I personally look at it. So Kevin, thank you so much for sending over your portfolio here. Best of luck with the wife. I hope that she allows you to retire early at the age of 50. And yeah, I'm glad that you found the channel. And whether you're a dividend investor or not, it's important to understand what your goals are, your strategy is, and make it work for you. But yeah, thank you so much for sending over your portfolio. And everybody, thank you so much for watching. I hope that the video was helpful. I hope that you learned something new. And I'll see everybody in next week's video. Thanks for watching.
Please subscribe. Please subscribe.
You know what? I think we're gonna be friends. Can everyone say hi to my friend? That's crazy. I just wanted to say thanks. I'm glad you came along, partner.